All right, welcome to The Explainer. Today, we're diving into a force so powerful it's been called the eighth wonder of the world, compound interest. It's this quiet, secret engine that can build incredible fortunes or, if you don't understand it, bury you in debt. So, what is this thing really?
Our sources kick things off with this super famous quote. Now, historians argue whether Einstein actually said it, but honestly, it doesn't matter. The idea itself just hits the nail on the head. It frames compounding not as some boring math term, but as a fundamental law of finance, kind of like gravity.
So, let's break it down. We hear the term thrown around all the time, but what's actually happening under the hood? We're going to pull back the curtain on the so-called magic, look at the engine that drives this wealth creation, and see how it works in the real world.
So here's our game plan for today. We'll start with the big idea, the eighth wonder. Then we'll get into the nuts and bolts of the compounding engine. After that, we'll see it in action with bonds and other cash-flowing assets. Then we'll talk about the mindset you need to make it work. And finally, how you can start your own compounding journey.
All right, let's get into it and build this thing from the ground up. Before we can use this powerful tool, we really need to understand how it's built, starting with the absolute core mechanics. At its heart, this is a beautifully simple idea. It's just earning returns on your returns. Think about a tiny snowball at the top of a really long hill. As it starts rolling, it picks up a little snow. But the bigger it gets, the more snow it picks up with every single turn. That acceleration, that's the magic of compounding. Okay, look at this number, 72. This single number, it's the key to one of the most powerful, useful mental shortcuts in all of finance. It lets you see the future in a way without ever touching a calculator. It's this fantastic little trick called the Rule of 72. Our sources highlight this as a quick back-of-the-napkin way to get an immediate feel for an investment's long-term power. It's pretty amazing. So check this out. It's super simple. Let's say you think you can get an 8% return on your money. You just take 72, divide it by 8, and you get 9. Boom. It'll take about 9 years to double your money. But what if you could get a 12% return? Well, 72 divided by 12 is 6. You double your money in just 6 years. This little rule just brilliantly shows how a small change in your return rate makes a massive difference over time. Now, the rule of 72 is awesome for a quick estimate, for sure. But if we want to really look under the hood and see the engine itself, we need to get into the real math. And for that, we have the future value formula. This might look a little intimidating, but it's not, I promise. PV is just what you start with. I is your interest rate. But the real powerhouse, the secret sauce in this whole equation is N, the number of years. See how it's an exponent? That means every extra year doesn't just add to your growth, it multiplies it. That's where the explosive power comes from. Okay, so that's the math, but math can feel a little abstract, right? So let's make this real. Our source material gives us a perfect example to see this engine at work, investing in bonds. This is where the numbers on the page turn into actual money in your pocket. The sources basically show us a fork in the road for an investor. Path number 1 is simple interest. You get your interest payment, that's called a coupon, and you spend it. Dinner, a movie, whatever. Your original investment just sits there. Path number 2 is compound interest. You take that exact same coupon payment and you immediately put it back to work, buying more assets that start generating their own returns. And this is where you can really see the difference. It's staggering. Look at this chart. In both cases, you start with $1,000 and get $1,500 in coupons over 30 years. With simple interest, that's it. You end up with $2,500. But with compound interest, by putting those coupons back to work, they generate an extra $1,900 of pure growth on their own. The final value is almost double. That column right there, reinvested growth, that's the magic. That is literally money that your money made for you. And here's a really crucial point. This isn't just about bonds or some dusty old savings account. Compounding works with any asset that throws off cash that you can then turn around and use to buy more assets. And this quote from our source material just nails the strategy. The whole goal is to create this amazing feedback loop, right? You use the income from your assets to buy more assets, which then produce more income, which you then use to buy even more assets. You're building your own little money-making machine. And you can see this play out everywhere. You could reinvest dividends from a stock, which automatically buys you more shares, which then pay you even more dividends. You could use crypto profits to grow your position. And in real estate, this is classic. You use the cash flow from one rental property to save up for the down payment on the next one. That's how one property becomes two, two become four, and that little snowball starts to look like an avalanche.
Okay, so you get the math, you see the examples, but here's the thing. That's the easy part. The sources are crystal clear on this. The biggest challenge isn't the formula, it's our own brains. To really get the benefit of compounding, you need a very specific mindset.
This quote right here, it gets to the absolute heart of it. The biggest rewards from compounding don't come from being a genius stock picker or making one big risky bet. They come from your temperament. It's about having the psychological strength to just let the process work its magic, year after year, without messing with it. And that is often the hardest part. So what does this mindset actually look like? Well, it's built on a few key things. You need the patience to fight that urge for instant results. You need the discipline to stick with your plan and keep reinvesting, even when the markets get choppy. Consistency is huge. Making those regular contributions is like adding fuel to the fire. You have to have a long-term view because the growth looks kind of boring for years and then it goes vertical. And finally, you have to manage your losses. You got to protect that snowball because you can't compound money you no longer have.
All right, so we've covered a lot of ground, right? The mechanics, the real-world examples, the mindset. Let's boil it all down to the most important takeaways so you can start your own compounding journey. If you remember one thing, make it this. Compounding is not a lottery ticket. It is not a get-rich-quick scheme. It is a deliberate, methodical, and honestly, often boring process that builds wealth slowly and then all at once. It's about the journey, not a single destination. And look, if compounding is a process, then its most powerful fuel is time. Our sources are all screaming this from the rooftops. Every single year you wait to start is a year you lose from the end of the curve, where the growth becomes absolutely explosive. Starting early with just a little bit of money is infinitely more powerful than starting late with a lot, all because of that tiny little N in the formula.
So that's what we'll leave you with. Understanding this principle is the first step, and you've just taken it. But the real game changer is putting it into action, making the choice to earn it instead of pay it. That is what truly builds a future. Thanks for watching this explainer.